Numbers are getting weaker on the economy as the numbers on inflation are getting stronger. It is stagflation. This is the perfect storm. The Fed has got itself in a box. There is no way out. And the fact that the Fed is in this no-win situation on inflation should not surprise anybody. This was the most obvious outcome that nobody wanted to acknowledge. I have been warning about this since the beginning. You go back to 2009 when Ben Bernanke first came up with his cockamamie idea of quantitative easing and 0% interest rates. What did I say back then? This was going to unleash inflation, and then the Fed was going to be in an impossible position because it's going to be unable to rein in the inflation that it let loose. I think for the stock market, this is just the worst start since 2016. I think maybe it's the third worst start over the last 30 years. In fact, both the Nasdaq and the Russell 2000 are down close to 7% so far this year. But it's the bonds that are really taking it on the chin. I think today was the worst day for the bond market since March of last year. This is the highest yields have been in over 2 years, up almost 100 basis points today. The yield settled at 1.865 on the 10-year, 30-year 2.184. These are still very, very low yields, but what's important is the trajectory and how much higher these yields can climb. In fact, if you look at the forecast now, most people are expecting now 5 rate hikes in 2022. In fact, a lot of people think the first rate hike, which is going to come in March, may even be 50 basis points. So we would lift off with a 50 basis point hike. In fact, Bill Advocaat is one of the people advocating for the 50 basis point surprise hike. He's calling it shock and awe. The ridiculous part about it is that 50 basis points is almost as ridiculous as 25 basis points. It's not shock and awe when you're talking about 7% inflation. A move from 0 to 50 basis points is still recklessly low interest rates. And for a Fed that's actually serious about fighting inflation, raising interest rates to 50 basis points is not nearly enough for the task at hand. Yet given the incredible amount of leverage that's in the system, a 50 basis point rate hike can still do a lot of damage. Even if we get more than the market expects, it still won't be enough to stop inflation from getting worse. And it seems clear that the bond market is slowly starting to pick up on this reality. Now, when it fully grasps it, the dollar will be tanking. It won't rally like it did today. Today we had some strength in the dollar, but at least the gold market didn't sell off. Now, it didn't rally, but one market that did was silver. The price of silver was up about 50 cents an ounce today. We closed around 23.5. That is a big move, especially on the day where the price of gold slipped about $5 an ounce. You don't normally see silver prices that strong unless you have a strong day in the gold market. But this really shows you the underlying strength in the commodity complex due to all the inflation that is already baked in this cake. But gold had a hard time rising today against that backdrop of surging bond yields. But at some point, investors are going to realize that surging nominal yields mean nothing to the gold market because real yields are not rising. The Fed is so far behind the curve. And even if real yields were rising, meaning that negative yields were becoming less negative, any negative yield is a positive for gold because you don't want to lose money in bonds. Whether you're losing 3% a year or 5% a year or 7% a year, all of that is bad. You want to avoid losses. One of the reasons that we had the big rally in silver today, and gold did rally. At one point this morning, it was down about $15 and it rallied. This was before the stock market opened because we got some economic news that surprised a lot of people in how weak it was. It was the January Empire State Manufacturing Index, and this number was at 31.9 in December. And this is what I have been warning about the entire time. The Fed is now starting its tightening campaign as the economy is rolling over. The economy is getting weaker, and they haven't even begun to raise rates yet. Look at the numbers I talked about for retail sales for December. The numbers are getting weaker on the economy as the numbers on inflation are getting stronger. It is stagflation. This is the perfect storm. The Fed has got itself in a box. There is no way out. And the fact that the Fed is in this no-win situation on inflation should not surprise anybody. This was the most obvious outcome that nobody wanted to acknowledge. I have been warning about this since the beginning. You go back to 2009 when Ben Bernanke first came up with his cockamamie idea of quantitative easing and 0% interest rates. What did I say back then? This was going to unleash inflation, and then the Fed was going to be in an impossible position because it's going to be unable to rein in the inflation that it let loose. In fact, for all the years that the Fed was claiming that inflation was too low, and of course this was just an excuse to hide behind to justify its reckless monetary policy. But when inflation was below 2%, at least based on the official way they measure it, of course unofficially it was never below 2%. We had inflation above 2% the whole time. The government was just pretending it was below 2% so they can claim we needed more of it. And of course I always argued that the whole premise that we need more inflation was nonsense to begin with, so that even if inflation was 1.5%, there was no reason to try to drive it up to 2%. In fact, if it's 1.5%, it could be lower, because 1% is better than 1.5%. But the Fed pretended that 1.5% was a problem, and they were going to solve that problem by pursuing policies to get the inflation rate up to 2%. And they often lamented the fact that they had been trying for years to get inflation higher, and they weren't able to succeed. And I was saying at the time, these guys are crazy, because the last thing they want is to have to deal with an inflation problem. Sure, they may have the tools, but there's no way they're going to use the tools, because if they use the tools that they know they have and that they claim will work, they will destroy the bubble economy that they created. See, the Fed has been operating looking in the rear view mirror for over a decade. What they do is they print all this money, keep interest rates artificially low, do QE, and then they look back at the CPI or the core CPI or the personal consumption expenditure index, whatever measure they like, and as long as that number is below 2%, they think the road ahead is clear. And they keep on printing money, they keep on stimulating, looking back over their shoulder, seeing where the inflation numbers are. And then all of a sudden, they look forward and they see 7% CPI in 2021. And of course, there was evidence that inflation was going to be bad early in 2021, but of course they ignored all that. They kept saying, well, this can't be, this is transitory, right? We know that we have low inflation, we've been in this low inflation environment, so whatever we're seeing, it must be related to COVID, it must be related to the economy reopening, oh, it's got to be about supply chain bottlenecks. Meanwhile, they're ignoring all the money they're printing because they had been printing money for years and years and years, and the CPI was below 2%. Well, now, because they printed so much money, because they were looking in the rearview mirror instead of looking ahead like I was doing from the beginning, now all of a sudden they're in this situation. They've got 7% interest rates. They can't slam on the brakes. So now they're trying to come up with some way to ease their foot off the gas, but that is impossible because that's not going to slow down the inflation. So the Fed made this bet, and now we all have to lie in it because they were too loose for too long, and they've let loose the mother of all inflation genies, and everything they're talking about doing is inefficient to actually put a stop to it. And of course, what they're doing operates with a lag. That's why I've been saying a lot of the inflation that we're experiencing now, today, isn't even the inflation that was unleashed during COVID. We're actually experiencing a lot of the price increases that is the result of the money they printed years ago. The money we printed last year, the money we're printing this year, we may be dealing with that inflation in 2023, 2024. Whatever baby steps the Fed makes now to push back against that tide, we're not going to feel that for years. And so interest rates have to keep going up. That is the problem that the stock market hasn't even really begun to grapple with. Even though you're seeing the big decline, particularly in these high-priced momentum stocks, in fact, the average stock now is trading 38% below its 52-week high. That is solidly in bear market territory. Even though the overall averages are not quite there yet, many of the stocks that comprise the averages are solidly in bear markets, but they're going to continue to go down because inflation is going to keep getting worse. The CPI is going to be under intense pressure from rising prices, and as more businesses pass on those higher costs to their customers, it is going to show up. And now the Fed is going to have to constantly talk about more rate hikes, more aggressive rate hikes, and the markets are going to continue to fall until ultimately they fall sufficiently for the Fed to have to call off the hikes and start reversing policy. And in fact, a lot of people already know this. That's one of the reasons that the market hasn't already fallen by more, because a lot of people recognize that a Powell put is out there. Even if the Fed wants to pretend it doesn't exist, everybody knows that there is a point where the Fed is going to cave. They can only talk about hiking rates for so long. And remember, they haven't done anything yet. All they've done is talk. Rates are still at zero. Maybe they've tapered their asset purchase program back a little bit, but they haven't stopped it. They're still purchasing bonds. Bonds are tanking even though the Federal Reserve is still buying. And I looked at some data today showing that foreigners and foreign central banks, for whatever reason, are still buying treasuries. Despite all that buying, they're still falling. Now, at some point, the foreigners aren't going to buy any more treasuries. They're also not going to buy any more of our overpriced stocks.